Okay, good day everyone. This is Mapletree Logistics Trust. Second quarter FY 24-25 financial results dated 22nd October 2024. Alright, let's look at the key highlights for second quarter. Okay, gross revenue is down 1.8% year on year. NPI is down 2.1% year on year. We compare with first quarter FY 24-25, which is the latest results before this. Right, you can see not dissimilar. Okay, down 0.3% and down 0.9%. Alright, so we look at DPU is down 10.6% year on year. Again, you can see that not very far away from first quarter, which was 8.9%. Okay, occupancy is roughly the same, 96, 95, not too much to say about them. Right, average rental revision is minus 0.6%, primarily because of China. If we exclude China, it's plus 3.6%. Right, so first quarter it was better lah. Okay, even with China it was plus 2.6%, and it's plus 4.6% excluding China. Okay, so yeah, aggregate leverage is going up, not something we are very happy to see. Okay, the rest I think nothing much to say lah. Alright, strong debt hedge to fixed rate, income hedge for the next 12 months 77%, right? All these things are good parameters, right? So divestment of 3 properties, alright. Generally, this one is quite good. 30% above valuation, 2.9 and 1.9% above valuation. So these two is a bit on the low side, right? And this Singapore property 34% above valuation, and this Malaysia property 7.4% above valuation. Right, so these are the completed ones. This one are still pending. Alright, on the way. Right, this one generally I would say is a good thing. Alright, they issued $180 million of perpetual securities at 4.3%. Right, this is to redeem 180 million of perpetual securities at a higher interest rate. Right, so yeah, they would save a little bit here, but you'll see later it's not such a big deal. Right, let's look at second quarter versus second quarter last year. Right, what is the big problems? Alright, we talked about gross revenue and NPI already. Borrowing cost is another problem. Alright, it's up $3 million, right, or 8.2%. Right, this is a big issue. Okay, the amount distributable is down by 9 million. Alright, from second quarter in last financial year. Alright, this is primarily due to the gross revenue being lower by 3.3 million. Alright, and the reasons here are given by lower contribution from China, absence of revenue from divested properties, and currency weakness from these 3 currencies. Right, so when you convert back to SGD, there's less SGD lah. Right, so mitigated by the positive contributions from Australia and Singapore, and also acquisitions made. And of course, currency weaknesses, we are aware of this lah. Singapore dollar is generally strong. Okay, so anyway, so this difference is caused by 3.3 million from gross revenue drop. Borrowing costs, of course, increased by 3 million. This is another 3 million, and then the rest is a difference roughly in divestments gain. Right, that means to say this amount here had 6 million added to it from divestment gain. This amount here has 8.7 million. Right, so the last 2.7 million difference actually come from divestment gains. Right, that's how they make up the $9 million drop. Alright, so perpetual securities, like I said, despite the fact that they refinance at a lower rate, alright, the payout here is higher. I think it's because they pay out earlier. Right, so I suppose there will be some savings in perpetual securities in the next report. Okay, but this is too small to move the needle lah, the difference. Right, so even though it's 12%, it's off a small base. Right, so it's just 700,000, maybe 750,000. Right, so not too much. Right, so to unit holders, the drop is around 9.1%. Right, so it's mainly due to borrowing costs, revenue dropping, as well as the less divestment. These are 3 main things lah. Right, so this is new. Alright, if you realize in the last report, this first quarter, right, I actually calculated 1.954, right, which is this value here, adjusted DPU, when I take out the divestment gains. Right, so now they are starting to report including this, which I think is a good thing. Alright, as to why I have my thoughts, maybe I'll share a little bit about them, but anyway, let's look at numbers first. Alright, so negative 8.8%, right, you can see it's smaller than the 9.1%. sorry, is smaller than 10.6%. So the actual DPU drop is 10.6%, but they're saying that, hey, if I strip out the divestment gains, actually the drop is only 8.8%. Right? My thoughts going forward is that they include this, right, because this makes the results look slightly better, alright, and also because I think that moving forward the divestment gains may be shrinking, right? So if we look at just DPU, right, we realize that this drop is very big, right? As with this case, you can see that, like I said, there are three factors that caused this to drop from last year. 1/3 is gross revenue, 1/3 is borrowing cost, and 1/3 is less divestment gain. Alright, so if I strip out divestment gain, the performance looks less bad. Alright, and that's why they are including this parameter now, right? And that's my suggestion, right? The slight difference between these two figures is because of the increase in the number of units, Okay, moving on. First half is more or less the same ideas, so I'm not going to go through. Alright, so again, DPU is down 9.8%, which is roughly the same as this, right? The average of 10.6 and the first quarter. Right, and again, they have this new column called adjusted DPU, down 7.9%. Alright, so nothing too special here to talk about. Alright, this one I think is the real performance that we are looking out for, because quarter on quarter, we actually already expected second quarter results versus the last financial year will be quite bad. Right, you'll be down 9, 8, 9, 10%, something like that, right? But it's between this quarter and the last quarter that we really care about, and we can see that actually the performance is slightly lower than the last quarter, right? So down 1.4% in terms of distributable amount to unit holders, right? So the DPU is actually down 2%, right? So actually lower by 2%. Then adjusted DPU is down 2.4%, right? So this one is a bit more operational in basis, Right, if we take out all the divestment gains. Okay, so again, nothing much to say. I think the rest is quite well discussed. Okay, you can see NAV per unit has dropped to 1.33, right, and leverage ratio has gone up. Alright, so net debt has increased by 63 million, mainly due to higher translated loans due to stronger JPY against SGD. So the Japanese central bank actually did raise interest rates slightly, so it can cause the Japanese yen to strengthen against SGD, and also SGD is pegged to USD, so we expect that there may be a little bit more of this moving forward, because interest rates in US has dropped and may continue dropping, and therefore SGD should follow suit. Right, they also took additional loans drawn to fund asset enhancement initiatives, and partially offset by loan payments. Right, actually I would prefer if they didn't take additional loans at this stage with such high interest rates. I hope rather that they use some of the divestment gains to pay for this, right? So give less dividends for now, but in the long run save on the interest cost. But you can see that their weighted average annualized interest rate seems to be still quite low at 2.7%. Alright. Yeah, so aggregate leverage has moved up to 40.2%. Right, we talked about this. Right, yeah, weighted average borrowing cost is still 2.7%, still very low. Right, yeah, this one we talked about it. Right, so JPY debt is a bit of a worry, alright, because of the rising interest rates in Japan. Luckily, there's very little interest loans left to refinance this financial year, so I think the interest increase shouldn't be that significant. Right, so yeah, we talked about this. 84% of total debt is hedged or drawn in fixed interest rate, so only 16% is variable. Forex risk 77% is hedged. Right, not talking about that. Right, you can see that of all their assets, everything is doing okay-ish except China. Right, so about 20% of their portfolio is just not doing well and expected not to do well. Right, so we look across the board, anything above below 95%. Surprisingly, Hong Kong is doing okay. Yeah, I think later on you look at rental regions, Hong Kong's numbers are actually quite alright as well. Right, China is the main problem. Right, other than China, I don't see any other issue. Right, so if I want to discount this portfolio, I will just discount the China side. Yeah, you can see the rental revisions here. More or less everything is okay-ish. Right, even Hong Kong is okay-ish. Right, last 2 quarters, Hong Kong's rental revision is okay. Right, so there's clearly a demand is still in Hong Kong. China is the bad part, and they say that yeah, it actually got worse. Right, and I expect this will also affect CapitaLand China Trust. right, which is another REIT that we cover here in this channel. Right, so this one not too much to discuss. Okay, they talk about rejuvenation, which I don't think I'll talk too much about lah. Yeah, divestments they've always done well. It's just a question of a lot of premium or a little bit of premium. So you see, these are the lesser premiums, lesser premiums to valuation divestments, right? So not so good, but maybe it's because we have high expectations of the REIT. Right, sustainability, not talking about the outlook. Yeah, I think the most important part is this, right? Trade tensions and geopolitical uncertainty, which affects every REIT that has overseas assets. Actually, Singapore also lah. Even if you are Singapore, you will be affected by this, right? Healthy portfolio occupancy, that's true. All right, China is the main issue. All right, if I want to buy this REIT, I have to discount China in the near term. All right, will the policies changes in China help? My thinking is actually it will help the retail side more. So if we want to think about who will benefit more from the China policy changes recently, my take is CapitaLand China Trust might benefit more. Alright, yeah, that's just my thoughts. Yeah, so these two we've talked about it a lot. Nothing much to say here. Yeah, development, nothing much. This is the this 6.8% in FY 24-25, which is this financial year. I think I expected this should be -10 to 15% rental revision again. This one may hopefully benefit from China's recovery, assuming China does recover, right? The logistics side should correspondingly recover as well. Yeah, so with that, I think I won't say too much about this. That's all for today's presentation. Again, none of this financial advice. Okay, please do your own due diligence. Thank you for listening.